no money on WorkCover, bad with money, bad divorce, no property, no savings.
You're thinking at least about investing, which is miles ahead of what the everyday person is considering to do with their money.
What would your tips be for a good accountant and a good financial advisor?
I really like the idea of meeting with 3 different options. The spouse contribution might be more relevant here.
The receiving person gets the benefit of getting the money in their super, compounding for their retirement, and the person that has contributed will get the tax offset of up to $540.
Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by BetaShares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, BetaShares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with BetaShares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast.
Tahli, welcome to this week's Q&A session on the Australian Finance Podcast.
Thanks for having me back.
I'm very excited to have you here. Owen is sick this week and it takes a lot to get Owen out of work, so he must be actually really sick. But it's great to have you fill in for him.
Yeah, big shoes to fill.
Yeah, definitely. So this week we've got lots of great questions that have come through. We have some on some great names too, some absolute great names, which I think is my favourite part of these Q&As, is looking at the hilarious names people send through. But before we jump into it, Owen and I always like to talk about what's happening in our week. So tell me about what's happening in your week this week.
Yeah, it's been a big week. I'm one of the advisors in the Rask advice team, and things are really starting to get pretty busy with the advice side of things. So that's a good problem to have. But we're definitely still finessing a lot of processes on our end and trying to slow down the pipeline a bit at the moment so that we can service clients and service them well. So that's taking up a lot of focus, but I am also heading away to Thailand next Friday.
Very exciting.
Which I'm so excited about because I'm based in Melbourne. So naturally this time of year, end of July, we're all a bit sick of being here and I can't wait.
Have you been to Thailand before?
No, I haven't.
I've never been there either.
Yeah, I've always been a shameless Bali fan.
Yep. I just went to Bali last week.
Yeah, I love it. I think if you go to the right places, Bali is beautiful. But yes, I am I'm stepping out of the comfort zone, making the big trip to Thailand. I say that sarcastically. But yeah, no, we booked an all-inclusive deal through Luxury Escapes. Not a sponsor.
Not a sponsor yet.
But honestly, I've always thought that they would probably not end up being a very budget-friendly option, given the name. Luxury Escapes always seems like something super bougie, but
So what does that include?
An absolute win. So it's 9 nights, all inclusive.
Like flights, accommodation?
Not flights.
Okay, cool.
So you have the option to add on your flights as part of their deal, like part of the package. But we just thought from a cost perspective, we can buy the flights a lot cheaper than doing it as part of their option. Because there's not that many options as well going from Melbourne to Thailand direct. So you've really got Jetstar as your option. So I'm really looking forward to it. And it cost us $3,200 all up for the 9 nights between two of us. So
that's so good.
Yeah. For Luxury Escapes, I think there's some absolute bargains on there.
Yeah. Well, we'll have to have you back on afterwards and then you can give us a review on your trip and some travel hacks and stuff like that. What's happening in my week? I just got back from Bali, but I already talked about that on the other podcast we did last week with Owen, how I did a bucket list dinner and I pretty much had to remortgage the house to afford it. But in a total flip of that reality, this week I travelled to Melbourne. I'm here in the studio with you. And I have gone travel hack crazy on saving money. So for the first time ever, and this is real tight ass behaviour, when I was leaving the airport, I had arrived in Melbourne and I was going to pick up my bag, I walked past the Virgin Lounge and I went in and had dinner and a wine on the way to pick up my bag. And then I was like, I saved myself $20-$30.
It makes sense.
Yeah, but the whole time I was like scoffing my food and sculling the wine because I was thinking about what if the carousel, like my bag, and it gets taken because I'm taking my time. But so I rushed through it. I could have enjoyed it a little bit more. By the time I got there, people were still waiting for their bags and mine wasn't out yet.
Damn.
So I'm going to totally do that again.
Yeah, you could have like filled yourself up with like a little package for the next day's breakfast.
I should have had a little Tupperware container with me. So I went into full tight ass mode. But yeah, it was really nice.
Yeah,
so I'm
nice.
probably going to do that again. So that was my little luxury escape in the Melbourne airport.
Wow, living it up. I love it.
Yeah, absolutely. But let's get into it. So we have some great questions that have come through. But as always, in these Q&As, and anytime you listen to one of our podcasts or any of our content, it's really important to know that this is for education and information and entertainment purposes. So any concepts that we talk about, financial strategies, products, it's really important that you seek advice to see if they're right for you. We can't give you personal advice. We don't know your circumstances, your goals, your needs and objectives. So please take this as education and information so you then know where you might go to next to get the advice and make sure that the things that you're doing are appropriate for your situation. But first name question come through. Now, this is actually a long name and long question. But so the name is Death, Taxes and Stuff My Parents Should Have Taught Me. Love it. Okay. Hi there. I've started some micro investing in the last 12 months, investing $500 a month into ETFs. I have an automatic contribution that goes into my broking platform. My wife and I also have a home loan with a redraw facility with a separate bank with our mortgage, I think. Yep. So just so far they're investing $500 a month into ETFs. They've got a home loan and they have a redraw facility. The mortgage is about $350,000 and they have $20,000 in that redraw. I'm wondering if I should take the $500 per month that they're already investing into the ETFs, put it onto the home loan first, then withdraw it straight out and put that money into ETFs. So what it sounds like happening is currently they have like a normal bank account that's got nothing to do with the home loan. And, you know, if pay goes in there, $500 a month is getting transferred into the ETFs. Mm-hmm. They're wondering if that should hit the loan and then go to the ETFs. So just an extra little transaction in there, but the same outcome really. I understand that would then create a tax deduction because essentially that $500 has gone onto that loan. They've said, I know that the tax deduction will be relatively small, but if it's possible, some is better than none. So they're just trying to clarify if that is a strategy that one, does it actually work like that? And if they should be considering it. So Tahli, I would love to get your take on this. This is a really common one that we get. So the strategy essentially is called debt recycling, but it's very, very easy to get this wrong. So tell us how you would, there's not really a question in here, but tell us how this works and if what they're thinking of doing would actually work.
Yeah, well, firstly, great to hear that they're regularly contributing to their investments. That's an absolute win in itself. And really good to be thinking of the tax deductibility of it as well. You know, from an advice perspective, we usually say tax deductions is not a goal, it's a consequence of other things that we do, and it shouldn't be the absolute focus. But coming back to the question itself, this is, textbook attempt, I would say, at debt recycling, which is a really effective strategy in the right circumstances, obviously. But it can go wrong very easily, and we can go into this specific case and how it is potentially going to go wrong for this person. So with debt recycling, essentially you're adding additional money into a non-deductible loan, and then you're taking it back out, which I'll go back into later, but you're taking it back out to then invest. So it's got an investment purpose, which then makes it deductible.
Yeah, because currently it's not, because it's their home loan. So they live in it. So the interest on that loan isn't tax deductible to the property, whereas if it was an investment property or an investment loan, like for the shares, it would be. Yeah.
Yes.
Right?
Yeah. So where people often go wrong with this is the structural side of things. So from an ATO perspective, they need to look at the purpose of the loan before determining whether or not your claim on the interest component is actually deductible or not. And so in this instance, the loan has been established for the purposes of purchasing a principal place of residence, so not deductible. To then claim a tax deduction on that amount, what you would need to do is actually refinance and create a separate loan split and separate the purpose of those two loans. So you really need to clearly differentiate between what component of the loan is being used towards your principal place of residence and what component is then being used for investing. And then once you've got the separate loan split, that specific component can then be claimed as a tax deduction. So that's a really important step, and it does involve engaging a mortgage broker to make sure those loans are correctly structured for you. And most likely as well, making sure you've got a tip-top accountant, and then maybe also bringing a financial advisor into the picture to make sure the strategy actually makes sense for what you're wanting to achieve in the long term.
Yeah. So essentially they are correct with their thinking on, well, that $500 would create a tax deduction, but the way that we're assuming that they're going to do it is based on their current structure, and they won't have that separate loan, and it will be very, very messy, and it won't be effective for tax purposes, record keeping, all of that kind of stuff. But essentially that's how it does work. But where we see people get stuck with debt recycling is they don't have that clear definition of what the actual loan's for, and it's mixed up in there.
Yeah, exactly. And last point on that as well is I think debt recycling, particularly in our community, is a very popular topic, and it is getting a lot of attention, and there's, absolutely a place for it. But in some cases, simplicity is best.
Yes. Yeah, that's like a lot of strategies. Like they look good on paper, or from a mathematical perspective, you're like, yes, there's a clear advantage to doing that. But then in reality, they might be a little bit more trouble than they're worth.
Yeah.
And this, they might find this with the small amounts that they're looking at doing and things. But I would chat to an accountant who's all over this kind of strategy. Absolutely talk to your lender and your mortgage broker about how easy it's going to be to clearly define different loans for different purposes. And if there's
additional cost involved to then refinance as well is a really important one.
Yeah, absolutely. But yeah, like when I look at strategies like this, I always like to think about how, like it might be a small amount now, but what will it look like in 2, 5, 10 years' time? And it might actually be that it's worth doing it even though there's little value now because of where this portfolio is going to grow to. And that's kind of like when you're setting up a company or a family tax structure, all that stuff. It's expensive, but potentially there's a crossover point within a couple of years that it was worth you paying a little bit extra initially for where you plan for that investment or something to be.
Yeah, that's a really good point.
Yeah, so there's a bit to consider there. We strongly recommend that you chat to your accountant in the first point and then talk to your bank. And then financial advice. All right, next one. Now, I had to double check this one to make sure I'm going to say it right. Stinky Binky.
Nice.
Okay?
Yep,
Stinky Binky. What are some tips on how to find a good accountant or a good financial advisor? This, again, is such a common one. So I will put in my 2 cents, and then I would love for you to give us some ideas on questions and things.
Yeah.
But I always think it's so important, like the relationship and the personality mash, but also that they have the skill set of what you need.
Yeah.
So I would say you have to clearly define what you want help with. Like what is the reason you're going to them? Because they're not all going to have the same specialty. Like financial advisors have different specialties. Accountants have different specialties. Like there might be ones that just do SMSFs, self-managed super funds. Some might specialise in property or businesses. So you need to know what type of professional that you're looking for. And then I would meet with at least 3, talk about their fees, talk about like just get see if you gel, right? You don't want to like hate dealing with this person, and personalities, matter. So I would talk to at least 3. What would your tips be for a good accountant and a good financial advisor?
Yeah, I really like the idea of meeting with 3 different options. And we always say that to people coming through Rask Advice that, don't speak to just us. Make sure you're speaking to a few different options. Mm-hmm. Speaking specifically to the financial advisor piece, shameless plug, I did write a blog post up on the Rask Media site about questions to ask advisors when you're going through that interview process. And I do like to use the word interview because I think it is really like you're screening a potential pool of applicants to step in and take charge of your personal finances. Like, it's a big responsibility. But yeah, there's a lot of things. And I think personality piece is a big one. Asking them about what their typical client looks like and making sure it sits or gels well with what your situation is as well. So you know that they're used to dealing a particular client that looks like you. Because, specific advisors might be more well versed in a younger demographic, or some choose to specialize in retirement and that transition. So that's really important. Also really important that you check on the ASIC advisor register as well, their AR number.
Yes. So that blog has lots of great tips. So we'll link that in the show notes so people can have a look at that as well. But yeah, I love the idea of meeting with a few. And one of my biggest frustrations when people are looking for accountants or financial advisors, or no, not so much that they're looking for them, but when I hear people say, oh, I won't see a financial advisor because of this experience I had in the past. And it might not be that it was bad advice, but they didn't gel with the advisor, or it wasn't the right advisor. They're like, oh, they couldn't help me. And I'm like, oh, you might have just gone to the wrong one. So I always say, like, we give mechanics and marriages second chances. Why don't we give financial advisors and accountants? Like, I tend to see people go, if they've had a bad experience with a mechanic or whatever, they're like, oh, just go, I'm going to someone else next time. But they don't go, we're going to service our own car. Whereas they go, oh, I met with an advisor, they couldn't help me, so now I'm just going to DIY, and they kind of give up on that. You just need to keep going until you find the one that the service works, the personalities work, you feel like you're going to be a team.
Last one as well on it, just to add one more point, speak to your personal circle. We all are hesitant to talk about money amongst our peers, and I think like that's probably part of the reason why it never comes up in conversation who your friends are seeing for their personal finances. But I think that's a really big one, because like if you have someone in your network that is already working with an advisor or an accountant that they really trust, that speaks volumes. So yeah.
It's a great starting point, like a personal recommendation, right? Yeah. Excellent. Okay, so moving on. This one is from Ready for Action. So this person says, I have $10,000 to invest. I'm 53, no money, except the $10,000, which is a lot of money. No money on WorkCover, bad with money, bad divorce, no property, no savings. My adult kids will spend it all if I don't invest it. I need help. What should I do? Oh, this is a really heavy. There's lots and lots going on here.
Yeah.
Wow, where do we start?
First one that immediately rings out to me is your mindset is probably the first focus point to address. Yeah. The things like
no money, the bad with money. Yeah, absolutely.
Yeah, that's all beliefs that we tell ourselves and convince ourselves are true. But, saying I'm bad with money looped into the same paragraph as I have $10,000 to invest, that tells me that you're probably not too bad with money. Yeah. You're thinking at least about investing, which is miles ahead of what the everyday person is considering to do with their money. So, mindset is a big piece to address here.
Yeah, and then the concerning thing about this is my adult kids will spend it all if I don't invest it. That's horrible, right? So boundaries with those adult kids, absolutely. And that's a tough thing. That's going to be mindset. That's going to be behavioral on both parts. That's a really, really challenging thing. But there's so much in this that we can't can't fix this person in this chat, absolutely, like this situation. But they have $1,000 to invest. There are so many things that need to happen, I think, from a foundations point. So you can be ready, you can feel ready to invest, but there's so many things from a day-to-day habits, mindset, how you manage your day-to-day cash flow. If they're on WorkCover, they might have a significantly reduced income than they previously have. So while they've identified that that's their major focus, I would think that there's quite a few other things there that need to happen first. I'm automatically thinking, where does this person get personal help from? I would be looking at if you're eligible for any financial counselling. So financial counselling is provided by things like the Debt Helpline, Salvation Army, all those types of things. And I can link some resources in the chat. So in the show notes. I would be looking if you're eligible for any of that stuff just to help you with the day-to-day. Like they've said, no money on WorkCover. You're going to need a lot of support outside of just this investing. And then once all of that is sorted and you're feeling a bit more confident with the day-to-day, the behaviours, the boundaries, with the money, all of that type of stuff, then there are some great free resources on how to actually start investing. So the Rask education has the free share investing course, the ETF course. There's lots and lots of free resources that would be great here, but I'm just really worried about the other foundational things. And I think going straight to investing might be putting a Band-Aid on things. When there's probably some bigger issues.
Yeah. And the last thing that you would want is to go ahead with investing a lump sum of money that might represent a really significant portion of your total wealth and then have pressure from the kids to fund a certain purchase and sell out at a market low.
Yes. Yeah, absolutely.
Yeah.
So getting really clear on, well, what's the purpose of this money? How long will it be invested? All of these things. And if you know how your cash flow is going, how all that other day-to-day stuff and feeling okay about that, then you'll be a lot clearer on how you can invest this money. If investing, so when I hear the word investing, I'm thinking shares, ETFs, that type of thing for this. But potentially, if you're thinking it needs to be locked away, then maybe you actually consider a term deposit or a bank account that it needs to be in for a certain amount to get interest. So if that gives you the boundary that then you feel comfortable saying, I literally can't get to it, then maybe that's your first step while you sort some other things out. It shouldn't be you're going to put it in an investment so they can't have it. There's probably some other steps. But this one here, I would love to see them reach out to financial counselling, see if they're eligible, get some help around the mindset, the boundaries. I'll link those free courses because I think they would be great. And then the other thing I'll say to this person, if they're listening, is we have on the Rask website, you can book a free 15-minute call. They come through to either Owen, myself, Mitchell, and it's just like, hey, I need help, but I don't know where to go. And we might say pretty much everything I've just said, financial counselling, these free courses. Sometimes people come through to those and we recommend they see an advisor or an accountant. It's just like hey, we've got all these resources, but sometimes you still don't know which one you need. So you could do one of those calls as well. But I really feel for this person. I think they're in a tricky spot, but there's so much opportunity here to make some huge changes in lots of different areas, not just that. Yeah. Investing.
Yeah. Yeah, I love it.
Cool. Okay. Next one. Miggy McGee. I always get nervous actually saying them because am I saying them
I was
right?
reading that and thinking to myself this whole time leading up to it, I have no idea how to pronounce that, but I think you've smashed it.
Is it Miggy? Miggy McGee?
Yeah, okay. It makes sense to me. We'll run with it.
Okay, great. All right, this one's for you, Miggy. This is Superannuation. Hi, my wife is off on maternity leave. I've been reading into the co-contributions and splitting my super. To her account so that long-term her balance doesn't suffer. What is your advice if your wife has a higher balance for you though? Add to her super or build mine. Very interested in your thoughts. One, I just love that you actually know that this is a thing and are thinking about the impact of her super while she's off like work. This is amazing. So absolutely love this. Do you want to jump into what you're thinking here? So the question is, they know that there's these strategies that they should be considering, but it sounds like her super's already higher. So
yeah, there's a lot of parts to this question that I love and that light me up inside. But just to quickly at a very high level talk about the options of contributing into her super during a time like this. So there's kind of three main strategies that we can play with here. One is the government co-contribution, which isn't mentioned here. The other is spouse contributions. And then the third is contribution splitting.
yes.
And all have different benefits and all of them are relevant in different circumstances. So firstly, to dive into each of those before talking about her having a higher balance first, just to quickly touch on the government co-contribution. So this is an incentive that would be for a low income earner to contribute to their own super and receive an incentive from the government for doing so. So this is available for people who are earning, I believe it's just below 60,000 this financial year.
Yeah.
So it wouldn't come from the partner who is working. It would be more applicable in the instance that the person who is not working is putting funds directly into their own super. And they receive a government contribution, sorry, lost my words, of up to $500.
Yeah.
So it's not a huge amount, but as we all know, any little free money from the government for a little tweak like that is a win.
It can be, it's a huge return on your money. So if you're earning under the 40-ish threshold and you put $1,000 in, you get $500 in government co-contribution. That is a massive return on your money. So that's a good one. But yeah, that goes into the super fund just from a standard bank account. Yeah. It's not from a contribution from work. It's after tax money.
Yeah.
Great. So the other one that you were talking about?
The spouse contribution might be more relevant here. So this is where you make a contribution into her super if her income is below $40,000 and you claim a tax offset for yourself of up to $540.
Yeah.
So again, little amounts of money that you're getting back for it.
Mm-hmm. Yeah. So this one, I do like this one. So where it caps out is if you were to put $3,000 into the spouses. And when we say you, it can be family money, right?
Yeah.
Like even the $1,000 for the co-contribution, it can come from a joint account.
Yeah.
It can be your money. It's just the way that it's recorded by the super fund. So this one is the spouse is adding it, but yes, it can be a joint account, whatever. But the receiving person gets the benefit of getting the money in their super, compounding for their retirement. And the person that has contributed will get the tax offset of up to $540, which is that. It's 18%, so it caps out at you put the 3,000 in. If you put under that, you would just get less of a tax offset. So it's a win-win for both. But all of these are based on like the income of the spouse as well. So it will depend on when she's gone on maternity leave, if she's worked part of the year, if she'll be returning, all of those types of things. Perfect. Okay, contribution splitting. Tell us about that.
This one is fun. So I think this one involves the least amount of work as well because contribution splitting, you're still contributing to your own super as you would normally throughout the year. And then retrospectively, you look back and you can move 85% maximum of what you have contributed as a tax-deductible contribution throughout the financial year or the previous financial year. From your super, you can transfer it over to your spouse's super. Mm-hmm. And the reason it's 85% is because when you're contributing to your super throughout the year, there's tax deducted from that at a rate of 15%. Mm-hmm. So all of what you've got put in, less the taxes, can get moved across into your spouse's super.
Yeah. So essentially it's if your employer's been putting in the now 12%, up to 85% of that money could go to your spouse between spouses. And why people will do this is for this exact reason, like somebody's off work and you want to make sure that their super's still growing, or your balances are way off and you're trying to balance them up as an overall strategy to get the best of the like tax-free amounts and things in retirement. So there's heaps of reasons why you would do this, but it's really common that we see it as a strategy when one person has taken time out of the paid workforce.
Yeah. And so in terms of the comment around her having a higher balance, this is an interesting one because some of these strategies that we talk about, and we talk about it with clients all the time, is that a lot of the rationale behind doing them might actually just come down to personal preference. So although her balance is already higher and it might not make much sense from a financial perspective for you to do any of these strategies, it might be more of a discussion between the two partners of, hey, I'm taking the time off work to build a family and I'm contributing my time to growing our household. I think it's only fair that some of your super contributions, maybe it's even 50% that you're splitting across every year, is going into mine. From a strategy and a financial benefit side of things, we usually use contribution splitting more so where one partner is at risk of hitting what's called their transfer balance cap, which is the maximum amount of your superannuation that can be transferred into a pension phase, which is where they start to have a 0% tax rate on earnings and withdrawals. So if you're close to hitting that transfer balance cap, naturally you want to start shifting some funds into the partner's account so they can equalise.
Even them up.
Yeah.
Yeah, when I read this, I don't automatically go, it's a hard and fast that, yes, you need to put money into her super. I 100% agree with you that it needs to be a conversation because maybe it's not actually about the dollars, it's about what that represents, and they put the value on that outside of what the super balances are doing. So I think it needs to be a conversation. The fact that you even know about it and are raising the question, I absolutely love. That just shows such a respect for the person being out of a paid role because that is a hard role to be in. Raising kids is tough. So this is a great conversation to have, but I don't think there's a hard and fast rule. If it was the other way, I honestly would be like, absolutely, but this one I'm just like, I don't know. I think it has to come down to it because usually we say, make sure you're considering this because we don't want that person to be disadvantaged and see one person's super just skyrocket and the other not.
Exactly.
But this one's a little bit harder and I think it's going to come down to how you guys manage things as your family household and where you see the value. But having the conversation is great. And maybe you decide, because this might cross over. We don't know how long she's going to be off work and it might cross over different financial years. What you do one year might be completely different the next year. And maybe you don't do this strategy, but when she's back working, she does some salary sacrifice or different things. Like you can employ different strategies, but the fact that you're thinking about this now tells me that I think there's a lot of respect in the relationship and like team money. And if you don't do it this year, I would want you to consider how you work as a team every single year because it's going to change.
Yeah, exactly. And, we don't know the numbers here too. So in terms of her having high balance now, we don't know when that threshold is going to be crossed and it reverses. So, there's a lot of factors to consider as always.
Absolutely. But you could, so also if these people are with, say, industry funds, for example, you could be getting free contribution advice every single year with your fund. Depending on what other funds you have, you might have a benefit like that. If you're thinking of putting money in, a lot of these, actually all of them, they don't have to be done throughout the year. You could set a reminder in your calendar for 1st of June. I love 1st of June because you still have a whole month to actually action it. So you could say, right, we're just going to sit tight. We want to do a super strategy, but we're not going to commit to it just yet. We're going to see where it lands with my earnings, your earnings, and then we're going to choose which strategy is best based on our other goals and the other commitments and things that we have going. But it's not necessarily something that you have to be doing each week or each fortnight. It could be sit tight, wait till 1st of June when you've got a picture of the last 11 months and which is going to be the most tax effective and meet your family goals.
Yeah, great.
Yep. Perfect. So that is the questions that we had coming through. So we had one on debt recycling, which we absolutely love. That was from death, taxes, and stuff my parents should have taught me. Stinky Binky was asking about how to find a good accountant and a financial advisor, and I will link in Tahli's blog that goes through that in a lot more detail. Ready for Action is looking to invest $10,000, but we identified that we think there's so many other opportunities there that we'd love you to focus on. So if you're listening, please reach out. We'd love to help you a bit more there. And then was it Miggy? Yeah, we went with Miggy, didn't we? Thinking about what to do with their wife's superannuation contributions while she's not working, which we absolutely love. So if you have any questions for us, you can head to the notes in your podcast player. You'll see a link where you can submit your questions. So send them through. You can put if they're to come through to us, the Australian Finance Podcast. You can pick if you want it to go to the Investors Podcast, the Property Podcast, or the Retirement one. Send them through. We absolutely love them. The funnier names, the better. Just not too tricky for me to pronounce. But yeah, and if you have any tips, travel tips and hacks, we have some episodes coming up on that. So we would love to hear them as well. So if you've got any tips or recommendations for podcasts, things that you want covered, just pop them in the same way that you would send in a question and we'll pick them up. We'll pick them up there. But Tahli, thank you so much for joining me on this Q&A episode, and we'll have you back on soon.
Thank you. Thanks for having me.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel, or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.